Welcome to Personal Finance Deep Dives, where we help you make your money work for you. Today, we're diving headfirst into one of the biggest financial decisions many of us make outside of buying a home: car finance. It's a world that, let's be honest, can feel incredibly complex. Lots of confusing terms, a dizzying array of options, but don't worry, we're here today to demystify it for you. We want to give you that insider knowledge you need to navigate this journey with confidence.
Absolutely. And it's so important because, a car isn't just a mode of transport anymore. For most people, it's a really significant financial commitment. It often sits right behind buying a home in terms of scale. And let me tell you, understanding how to finance it wisely can genuinely save you thousands, maybe even tens of thousands, over the car's lifespan. Plus, the market itself, well, it's been shifting dramatically in recent years, hasn't it? Which makes these informed decisions even more critical.
Definitely. So what's the plan for today?
Okay, our goal today is simple: equip you with all the insights you need to navigate this landscape confidently. We're going to talk about everything, starting with the foundational stuff, like understanding interest rates and loan terms. Then we'll get into the more nuanced considerations, like buying versus leasing. That's always a big one. We'll even touch on how broader economic conditions kind of silently play a pivotal role in the deal you get. We'll break down the key factors, give you the inside scoop, if you will, on how lenders make their decisions, and arm you with actionable strategies to secure the best possible deal out there.
Fantastic. Let's jump right in then. Okay, let's unpack this and start with the absolute core of car finance.
Okay.
The auto loan itself. When you take out a car loan, what exactly are you getting into?
Right. At its simplest, it's about getting a lump sum of money from a financial institution. That could be a bank, maybe a credit union, or even the automaker's own finance company. And then you pay it back plus interest over a set period of time.
Think of it like a three-piece puzzle, right, where each piece is interconnected.
Mm.
And together, they determine not just your monthly payment, but also the total amount you ultimately pay for that vehicle.
That's exactly right. The first piece, probably the most obvious one, is the loan amount. This is the principal, the actual sum of money the financial institution lends you. Now, importantly, this amount isn't necessarily the sticker price you see on the car.
Ah, good point. How so?
Well, it can be significantly less if you have a vehicle to trade in. The value of that trade-in reduces the amount you need to finance. Or if you choose to make substantial down payment up front. And here's a critical insight: every single dollar you don't borrow translates directly into interest savings down the line.
So the less principal you borrow, the less total interest you pay, even if the rate's the same.
Exactly. It's not just about saving that principal amount itself. It's about avoiding paying interest on money you didn't actually need to borrow in the first place.
Okay, that makes sense. So that's piece one, the loan amount. What's piece two?
Piece two is the annual percentage rate, or APR. Now, this isn't just a simple interest rate. It's your effective kind of all-in cost of borrowing the money, expressed as a yearly percentage.
So it includes fees and other costs, not just the interest.
Precisely. It might encompass things like origination fees or certain closing costs associated with the loan. This is why comparing APRs, not just the advertised interest rates you might see, is so critical when you're shopping around for a loan. A lower APR simply means less money out of your pocket over time. It's the true measure of how expensive that loan is.
Got it. APR is the real cost.
Yeah.
Okay, piece three.
And the third, equally crucial piece is the loan term. This is simply the length of time you have to repay the loan. Historically, terms typically range maybe 36 to 72 months. That's 3 to 6 years. However, in the current market, we are seeing much longer terms being offered more frequently, sometimes stretching to 84 months, which is 7 years, or occasionally even beyond that.
Wow, 7 years or more.
Yeah. And what's often overlooked is how these three factors, the loan amount, the APR, and that term length, interact. They profoundly shape both your monthly payment and your total financial outlay over the entire loan.
Can you give us an example of how that works in practice?
Sure, let's dive into a practical example because this is where the numbers really come to life. Imagine you're financing a $25,000 car. Now, if you can proactively reduce that loan amount by just $2,000, maybe through a strategic down payment, or perhaps you have a valuable trade-in, or maybe you even negotiated the car's price down effectively, that $2,000 reduction can have a substantial impact. So let's say you have a 4-year loan at a 3.00% APR. That seemingly modest $2,000 reduction in principal, it could save you over $44 per month.
Over $44 a month just from knocking $2 off the loan.
Yeah, $44.27 to be precise. That's money that stays in your pocket every single month. And over the course of that 4-year loan, that adds up to over $2,100 in total savings. That's real money, directly cutting your overall cost of ownership. It really highlights the power you have in controlling that initial principal amount.
That example definitely shows the power of the loan amount. But let me tell you, here's something crucial that I think many consumers miss. A lower monthly payment doesn't automatically mean you're saving money overall. That's a common trap, isn't it?
It absolutely is. We often fixate on that attractive, seemingly more affordable monthly number, right? Believing it signifies a better deal. But you must look at the bigger financial picture. You have to consider the total cost of ownership.
So using that same example, what if you stretch the term?
Okay, let's do that. Take that same $25,000 loan, keep the 3.000% APR, but now extend the repayment period from 4 years to 5 years. Your monthly payment drops by about $104.14.
Over $100 less a month. It sounds great on the surface.
It does. But, and this is the key, by simply extending the term by that single year, you'd actually end up paying an additional $391.85 in interest charges over the entire life of that loan. So that short-term relief you feel on your monthly budget, it translates directly into a greater long-term expense. You pay more in the end.
Okay, so that begs the question. Why does a longer term cost more overall, even if the monthly payment is lower? How does that work?
It boils down to how car loans are structured. Unlike, say, some investment accounts where interest compounds on previous interest, car loans typically use simple interest. This means interest is calculated each month only on your remaining principal balance.
So, no interest on interest.
Right. That's a crucial point because as you consistently pay down the loan, the amount of interest you're charged each month actually decreases, even if your interest rate stays the same.
Okay, but there's more to it, right? You mentioned amortization.
Yes. Even though it's simple interest, these loans are amortized, much like mortgages. This means that the total interest you owe over the life of the loan is heavily front-loaded into your early payments. So in the beginning of your repayment schedule, a disproportionately larger chunk of your monthly payment goes towards paying off the interest charges, and a comparatively smaller portion goes toward paying down the actual principal, the amount you borrowed.
And then that shifts over time.
Exactly. As the loan progresses, that allocation gradually shifts. More and more of your payment starts chipping away at the principal. This really emphasizes why making extra principal payments, if you can afford it, can be so powerful in saving interest and paying off the loan faster.
Now, this front-loading of interest, combine that with another big financial reality, depreciation. That can create a particularly tricky situation for borrowers, can't it? One that catches many people off guard.
It absolutely can. Let's be blunt. A car starts losing a significant chunk of its value almost immediately, often the moment it's driven off the dealership lot.
That famous depreciation hit.
Yeah. And this rapid depreciation means that, especially in the early stages of a longer loan where you're paying mostly interest, you can quickly find yourself underwater.
Underwater, meaning you owe more on the loan than the car is actually worth in the current market.
Precisely. It's a concept that might sound familiar from what happened in the housing market years ago when prices collapsed, leaving homeowners with mortgages bigger than their home's value. This is crucial because it directly impacts your financial flexibility and can become a real headache later on.
How so? What happens if you need to sell or trade it in early?
Well, if you're underwater and you unexpectedly need to sell or trade in your vehicle early, maybe you got a new job with a different commute, or your family grew and you need more space, or you simply just want a different car. You might find yourself in a very difficult spot. You could have to pay the difference between the car's market value and your outstanding loan balance just out of your own pocket to get rid of it.
Ouch. Or worse.
Or worse, and this is a common and frankly dangerous pitfall, you might roll that negative equity, that leftover loan balance, into your next car loan. This essentially means you start your new vehicle purchase already in a hole, borrowing more than the new car is even worth on day one. It just exacerbates the cycle of debt, putting you further behind before you even turn the key. So understanding these mechanics, how amortization and depreciation work together, and how they can potentially trap you, it's absolutely key to making sound financial decisions and avoiding financial pain down the road.
Right. So, summarizing this crucial first section then, remember this, folks. The fundamental mechanics of auto loans, that's the loan amount, the APR, and the term, they profoundly impact your total cost. And while a longer loan term might offer that tempting lower monthly payment, it almost always leads to paying significantly more in interest over the life of the loan. You've got to look at the full, long-term picture, not just that immediate monthly payment. That brings us to takeaway number 1. Okay, so we've covered the basics of how the loans work, those fundamental components. But now let's dig into what truly drives the interest rate you're ultimately offered. It's not just some random number lenders pull out of thin air, right?
Not at all. There are several key elements that lenders scrutinize really carefully. Some of these are entirely within your control, which is good news. Others, well, they're influenced by broader economic forces that are kind of beyond your immediate reach.
So what's the biggest factor, the one that really moves the needle?
Without a doubt, the most significant factor, and probably the one where you have the most direct control, is your creditworthiness. And that's primarily reflected in your credit score. Lenders use this score as their primary tool to assess the perceived risk of lending money to you. Think of it like a financial report card.
Higher score, lower risk, better rate.
Exactly. The higher your score, the lower the risk in their eyes, and usually the better the interest rate you're likely to receive. Let me give you some numbers, because the data from the first quarter of 2025 is incredibly telling. If we look at new car loans, a buyer with an excellent credit score, we're talking 781 or above, sometimes called super prime, could expect an average interest rate of just 5.18%. Pretty low.
Okay, 5.18% for excellent credit. What about the other end?
Well, for someone with a poor credit score, maybe in the 300 to 500 range, that average rate jumps dramatically to 15.81%.
Wow, nearly triple.
Yeah. And the difference for used cars, even more stark. It ranges from about 6.82% for excellent credit all the way up to a staggering 21.58% for poor credit. It just perfectly illustrates how incredibly powerful a strong credit history, showing consistent on-time payments, responsible financial behavior can be in determining your borrowing costs. It's truly a financial superpower.
That's a huge spread. And it's not just the number, right? Lenders dig deeper into your actual credit history too, don't they?
They absolutely do. It's not just a snapshot score. A past history filled with missed payments, any records of bankruptcies, or maybe past vehicle repossessions, that can make it incredibly tough to secure a low interest rate, even if your current score might look decent on the surface. Lenders are looking for a consistent pattern of reliability and financial discipline.
So a clean history really helps.
Oh, immensely. Conversely, a perfect payment history, demonstrating a long track record of managing debt responsibly, works incredibly in your favor. It signals stability and trustworthiness, and let me tell you, they don't stop there. They meticulously analyze your annual income and, very importantly, your debt-to-income ratio.
Explain that one quickly, debt to income.
Sure. It's the percentage of your gross monthly income that's income before taxes that is already dedicated to making monthly debt payments. Things like mortgage or rent, student loans, credit card minimums, other loans. A high debt-to-income ratio signals to lenders that you might be financially stretched thin already, making you a higher perceived risk. And that can lead to a higher interest rate or potentially even getting denied for the loan altogether.
Okay, so credit score, history, income, debt to income. Those are personal factors. What about the bigger picture? Economic conditions.
Right. Economic conditions play a huge and often unpredictable role. For example, when inflation is high and the economy is perceived as running hot, the Federal Reserve, our central bank, often takes action. They might raise the federal funds rate.
The rate banks charge each other.
Exactly. It's the target rate for overnight lending between banks, and it acts as a foundational benchmark for interest rates throughout the entire economy. This federal funds rate directly influences the prime rate, which is a key reference point lenders use to set the interest rates on various types of consumer debt, very much including auto loans. So the ripple effect is clear. When the Fed raises rates to try and cool down inflation, auto loan rates usually follow suit. It reflects the increased cost of borrowing for the financial institutions themselves.
And that's happening now, right? Rates are higher.
Yes, in fact, we've observed that car loan interest rates are currently near their highest point in the past 4 years, precisely because of these ongoing efforts by the Fed to manage inflation. It's a factor that impacts pretty much everyone looking for a loan, regardless of their individual credit score.
That's definitely a macro factor outside our direct control. But what about things you can influence? I know lender policies vary a lot. Why is that, and what should people know? It seems you could get really different offers for the same person.
You've hit on a really critical point for anyone strategically shopping for a loan. This is precisely why you can get pre-approved for an auto loan by several different financial institutions, maybe a big national bank, your local credit union, even the captive finance arm of an automaker like Ford Credit or Toyota Financial, and receive vastly different interest rate offers from each one, even for the exact same car and with your identical credit profile.
So why the difference?
Every lender operates with its own unique internal criteria. They have their own risk appetite, their own specific business needs and profit targets. They each have their own financial forecasts and strategic objectives that shape their lending decisions on any given day. For instance, a large national bank might prioritize borrowers with super high credit scores and existing customer relationships, whereas a local credit union, because it's member-owned and not solely driven by profit in the same way, might have more flexibility or offer slightly better rates for those with average credit, maybe focusing more on community loyalty.
And the car company's own finance arms.
Right, the captive finance arms. They often offer special promotional rates, maybe 0% or 0.9% APR, but usually only tied to specific models they want to move or during certain sales events. They might be less flexible on other terms, though. It's really a spectrum, and each type of lender has its own niche and priorities. This is why shopping around isn't just a suggestion, it's a strategic imperative. It truly puts you in the driver's seat when negotiating.
That absolutely puts the ball back in the consumer's court, knowing that.
Right.
Okay, but what about the loan terms themselves? We talked about the term length affecting the total cost, but do the specific terms of your loan also affect the interest rate you're offered?
That's an excellent question, and yes, they do. The specific terms you negotiate for your loan directly impact the rate lenders are willing to offer. For example, a larger overall loan amount, borrowing more money, can be perceived as inherently riskier for the lender. That might lead them to offer you a slightly higher interest rate to compensate for that increased exposure.
And shorter terms.
Conversely, shorter repayment terms, as we discussed, typically come with lower interest rates. Part of the reason is simply that there's less time for your financial situation to change unexpectedly over, say, 3 years compared to 7 years. That reduces the lender's perceived risk. And, critically, a higher down payment, the upfront cash you contribute towards the car's purchase, signals significantly less risk to the lender.
That skin in the game idea.
Exactly. It demonstrates you have a vested financial interest in the vehicle right from the start. This often results in a lower interest rate being offered. And as a beneficial side effect, of course, a larger down payment naturally reduces your monthly payments too, because you're borrowing less principal. The less you need to finance, the less risk the lender assumes, and the better the terms you're likely to get.
Finally, does the vehicle itself actually matter to lenders when they're determining the interest rate? Does a brand new car get a different rate than a used one?
Oh, it absolutely does matter, and it often makes a significant difference. New cars generally qualify for lower interest rates compared to used cars.
Why is that?
Several reasons. New vehicles are obviously less likely to experience mechanical breakdowns soon after purchase. They're typically covered under comprehensive manufacturer warranties, and they tend to hold their value more predictably, at least in the early years. So, from a lender's perspective, a new car represents a more secure asset backing the loan.
And used cars.
On the other hand, older cars, especially those with high mileage, might face higher interest rates from lenders. This is due to the increased perceived risk of mechanical issues cropping up, more rapid or less predictable depreciation, and a higher chance of the loan becoming underwater more quickly. In fact, some lenders might have cutoffs. They may not even be willing to finance a vehicle if it's, say, older than 10 years or has accumulated more than perhaps 100,000 or 120,000 miles. They might just deem those too risky for their portfolio.
Is there data to back that up?
Oh yes, the data clearly supports this distinction. On average, if we look again at Q1 2025, new car loans had an average interest rate of 6.73%. That reflects that lower perceived risk profile. But in stark contrast, used car loans during the same period averaged a much higher 11.87%.
Wow, nearly double the rate for used cars.
Exactly. It truly underscores the significant financial impact your choice of vehicle, new versus used, its age, its condition can have on the interest rate you end up paying.
Okay, let's bring it all together for this section then. Your auto loan interest rate. It's a pretty complex calculation. It's based on your creditworthiness, the current economic conditions, the specific lender's policies, the loan terms you choose, and even the type and condition of the vehicle you're buying. The good news, though, is that many of these factors are within your direct control, which highlights the profound importance of preparation before you even start looking at cars. That brings us to takeaway number 2. All right, let's pivot now to a fundamental decision that many of you face when you're considering getting into a new vehicle. Should I buy a car or should I lease one? This isn't really a one-size-fits-all answer, is it? It's a choice that comes down to a careful assessment of your personal financial situation, your lifestyle needs, and really what your priorities are in terms of vehicle ownership and how you use it.
You're exactly right. It's very personal. At its core, leasing a car is fundamentally like signing up for a long-term rental agreement. You enter into a contract where you pay a fee to use the vehicle for a set period, which typically spans maybe 2 to 4 years. The crucial distinction here is that you do not own the car at any point during that lease.
So what are your payments covering then?
Your monthly payments are calculated specifically to cover the vehicle's expected depreciation during that lease term. Essentially, you're paying for the value the car is expected to lose while you're using it. At the end of the lease term, you simply return the car to the dealership. Though, it's important to note you often have an option to purchase it for a predetermined price, called the residual value, if you decide you want to keep it.
Okay, that's leasing. What about buying?
In contrast, buying a car means you definitively own the vehicle, or at least you're on the path to owning it. Whether you choose to pay for it entirely with cash up front, or more commonly finance it through a loan, you are actively building equity with each payment you make towards the principal balance. Once that loan is completely paid off, the car is entirely yours, free and clear. It's your asset to do with as you please.
Okay, let's unpack this with the pros and cons, starting with leasing. What are the big benefits that draw people towards leasing a vehicle?
Well, a big pro that immediately jumps out for many people is often a lower monthly payment compared to buying the exact same car. And that's because, as we just discussed, you're only paying for the vehicle's depreciation over the lease term, not its full purchase price. So you're essentially financing a smaller portion of the car's total value.
Lower payments, that's attractive. What else?
Another appealing aspect is that you typically need little to no down payment to initiate a lease. This can be a significant advantage if you don't have a large sum of cash saved up for an upfront payment. And for those folks who love staying current with the latest models, leasing allows you to drive a new vehicle every couple of years, always benefiting from the newest technology, safety features, and that new car smell.
Plus warranty coverage, right?
Huge point. Critically, these leased vehicles are almost always under the factory warranty coverage for the entire duration of the lease term. That means fewer unexpected and potentially costly repair bills, a major source of peace of mind for many drivers. Plus, when the lease finally ends, there's typically no hassle of reselling the car yourself or dealing with the complexities and negotiations of trading it in. You just hand back the keys, maybe sign some paperwork, and walk away. It's designed to be a very convenient cycle.
Okay, that lower payment. Always having a new car under warranty. No resale hassle.
Yeah.
That certainly sounds appealing. But what are the hidden downsides, the cons of leasing that people might overlook?
Well, the most significant drawback, undoubtedly, is no equity. Your monthly payments are, as we said, effectively like rent payments. They don't contribute to building any ownership stake whatsoever in the vehicle. At the end of the lease, you simply walk away with nothing tangible to show for all those payments you made. There's no asset to sell or trade towards your next vehicle.
You start from scratch every time.
Exactly. You also face pretty strict restrictions on use, particularly concerning annual mileage limits. These are often quite low, typically ranging from maybe 10,000 to 15,000 miles per year. If you exceed these limits, you can incur significant per-mile fees that can really add up quickly at the end of the lease.
And wear and tear.
Yes. Furthermore, you're financially on the hook for any damage that goes beyond what the leasing company deems normal wear and tear. Things like significant dents, large scratches, stained upholstery. Those can also lead to hefty charges when you return the car. Also, early cancellation penalties for leases can be particularly substantial and very difficult, often impossible, to escape without significant cost. This makes leasing far less flexible than owning if your personal circumstances change unexpectedly midterm. And finally, you generally cannot make any significant modifications or customizations to the car. No aftermarket stereos, no different wheels, because, fundamentally, it doesn't truly belong to you. It's not your car to alter.
Okay, lots of limitations there.
Yeah.
Now, let's flip it. If we look at buying a car, what are the primary benefits that stand out compared to leasing?
Well, the first and most obvious pro is crystal clear. Ownership and complete control. Every single payment you make on your auto loan builds equity in the vehicle, contributing towards your tangible asset value. And once that loan is fully paid off, the car is entirely yours, free and clear to do with whatever you please.
Meaning?
meaning you can drive unlimited miles without facing any penalties. You can customize it to your heart's content, add accessories, change things. You can sell it whenever you like to whomever you like. You can trade it in for another vehicle when you're ready, or you can simply keep it forever, long after the payments stop. You have the ultimate flexibility to sell or trade it whenever your personal needs or financial situation changes. And importantly, most auto loans these days come without prepayment penalties, allowing you to pay it off early if you wish, which further reduces your total interest costs.
That sense of ownership and control definitely sounds great. But what are the common cons of buying that people should be aware of, especially when comparing it directly to leasing?
Yeah, the cons of buying often center on higher costs, both upfront and ongoing. You'll likely need to make a larger down payment than you would for a lease, often a significant percentage of the car's purchase price. And your monthly loan payments tend to be higher than comparable lease payments for the exact same vehicle. Why? Because you are paying for the entire value of the car over the loan term, not just its depreciation during a shorter period.
And then there's depreciation itself.
Right. You, as the owner, actively face depreciation, which is a powerful, unavoidable financial reality. A brand new car could easily lose almost half its value in just the first 5 years and maybe 75,000 miles, particularly if you don't maintain it well. That's a substantial loss of value that you, the owner, absorb directly. And unlike a lease where the warranty typically covers most repairs for the duration, when you buy, you become entirely responsible for all maintenance and repair costs once that factory warranty expires. This can lead to unpredictable and potentially significant expenses down the line, which can be a real shock for some people who are used to warranty coverage.
Now, beyond just traditional buying and leasing, I've started hearing about emerging alternatives, like auto subscription programs. How do those fit into this picture? What makes them different?
That's a great point. As the market is constantly innovating, looking for new models, auto subscription programs are distinct from leases in some key ways. They are similar to leases in that you don't own the car, you're just paying for access, but they often come with significantly higher monthly payments compared to a typical lease or loan. However, the catch is that these payments are usually designed to be truly all-inclusive.
All-inclusive meaning.
Meaning they often cover not just the use of the vehicle itself, but also the cost of insurance, all scheduled maintenance, and even roadside assistance services, all bundled into one monthly fee. They're specifically designed for shorter-term access than leases, sometimes allowing you to have a car for just 1 month or maybe 3 months, offering maximum flexibility. A unique feature some offer is the potential to actually switch vehicles during the subscription term. Maybe you need an SUV 1 month and a sedan the next. So it provides a truly all-inclusive, very flexible, and hands-off monthly payment experience, but it definitely comes at a premium price point. They really cater to a niche market that values extreme convenience and variety over long-term ownership or lowest cost.
Okay, so with buying, leasing, and now subscriptions, which option is truly right for our listener? How should they weigh buying versus leasing?
It really depends entirely on your individual lifestyle, your typical driving habits, and your overarching financial priorities. There's no single right answer. If you prioritize having a brand new car at a lower monthly cost, you don't drive excessively high mileage, and you enjoy the convenience of switching vehicles frequently without the hassle of ownership, then leasing might be a very appealing and practical option for you. It's often ideal for someone who wants predictable, lower monthly transportation costs and always wants to be driving a new car that's under warranty.
But if you value ownership,
Right. If you place a high value on ownership, you desire full control over your vehicle, you want the freedom to drive as much as you like without worrying about mileage caps, and you appreciate the idea of a car payment eventually disappearing entirely, then buying is likely the better and often more financially advantageous fit for your long-term goals. Buying is really about building an asset over time and eventually achieving the freedom of being free from monthly car payments altogether.
so, to summarize this section then, the choice between buying and leasing involves a fundamental trade-off. It's really about weighing those lower monthly costs and the perk of always driving a new car that comes with leasing versus the benefits of building equity and having full control and flexibility that comes with buying. Each option has really distinct financial and lifestyle implications that you, our listener, need to weigh very carefully based on your own personal situation and priorities. That brings us to takeaway number 3. Okay, so you understand how car loans work, the core components. You've thought about whether buying or leasing is the right path for you. Now let's get into the actionable strategies, the specific moves that can truly help you secure the absolute best deal when it's time to finance that next vehicle. You definitely don't have to just passively accept the first interest rate or terms offered. There are powerful ways you can avoid overpaying and really ensure your money is working smarter for you. Where should we start with these strategies?
Well, what's often overlooked, I think, is how much power you actually have to influence your own loan terms before you even start seriously looking at cars or talking to dealers. First and foremost, a absolutely crucial step is to actively work to improve your credit score.
We talked about how much it impacts the rate.
Exactly. A higher credit score signals significantly less risk to potential lenders, and as we saw, it can translate directly into a substantially lower interest rate being offered. And this isn't just about saving a few pennies, it's literally thousands of dollars saved over the life of your loan. So, if your score is currently low, or even just kind of average, take proactive steps now, well before you need the car.
Like what kind of steps?
This means things like paying down existing credit card debt, especially high balances, making sure you catch up completely on any past due payments, and limiting new credit applications in the months leading up to your car purchase, as each new inquiry can temporarily lower your score slightly. Critically, pull your credit reports. You can get them for free annually, and if you discover any inaccurate information, dispute it immediately with the credit bureaus. Even a seemingly small increase in your credit score, maybe 20 or 30 points, can translate to meaningful financial benefits and savings on a car loan. It's probably the most impactful lever you have.
That's a really foundational step. But let me tell you, here's another crucial strategy many people miss out on. Shopping around for financing. I've seen it so many times. People just walk into a dealership and only consider the financing options presented to them right there on the spot by the finance manager. But getting pre-approved elsewhere first is key, isn't it?
Oh, it's absolutely crucial. A truly vital strategy is to get pre-approved for an auto loan with multiple lenders. And this absolutely includes traditional banks where you might already have accounts, but also, importantly, member-owned credit unions before you ever step foot onto a car lot.
Why is doing that beforehand so important?
It's important because it gives you immense leverage and knowledge. This proactive approach allows you to compare actual concrete interest rate offers and loan terms side by side. It puts you in a strong negotiating position. You can even use a competing pre-approval offer that you've secured from, say, your credit union to negotiate a better deal with your preferred lender or even with the dealership's own finance department. They might be willing to match or beat it to get your business.
And credit unions often have better rates.
Yes, often they do. Because they are member-owned cooperatives and not primarily driven by maximizing shareholder profit in the same way traditional banks are, credit unions frequently offer more attractive rates and potentially more flexible terms, especially if you're already a member. Imagine working into that dealership finance office already knowing exactly what rate you qualify for from your own bank or credit union. That knowledge completely changes the dynamic of the negotiation. It prevents you from being pressured or potentially steered into a less favorable deal simply because you didn't know your options.
That makes perfect sense. Puts you in control. Okay, so once you're looking at loan offers, what about the structure of the loan itself? Should people just aim for the lowest possible monthly payment, or is there a smarter move regarding the loan term?
That's a vital question we touched on earlier. While that lower monthly payment might seem incredibly appealing in the short term, remember, it's often tied directly to a longer loan term, which ultimately costs you significantly more in interest over the long run. So my strong advice is always to opt for the shortest loan term that your budget can realistically and comfortably accommodate.
Why shorter?
Well, choosing a shorter repayment period, say 48 or 60 months instead of 72 or 84, typically comes with a lower interest rate offer from the lender. As we discussed, there's simply less time for your financial situation to change, reducing their risk. But more importantly, it drastically reduces the total amount of interest you'll pay over the entire life of the loan. Yes, your monthly payment will undoubtedly be higher with a shorter term, but the long-term savings and interest charges are significant, often saving you thousands and thousands of dollars. It's a trade-off that prioritizes long-term financial health over short-term budgetary ease. Plus, you own the car free and clear much sooner.
And what about the cash you put down upfront, the down payment? How significant is that in getting a better deal?
It's a hugely powerful lever that's entirely within your control. Your down payment plays an absolutely critical role. The more money you put down up front when purchasing the vehicle, the less you actually need to borrow from the lender. It's simple math. This action significantly reduces the lender's risk exposure because their financial stake in the vehicle is immediately lower right from day one.
And that leads to better terms.
Yes, a substantial down payment can directly lead to a lower interest rate offer, a smaller monthly payment because the principal is lower, and ultimately lower total borrowing costs over the life of the loan. It clearly shows lenders that you have skin in the game, as they say. It demonstrates your commitment and reduces their potential for loss if your circumstances were to change. A general rule of thumb many financial experts suggest is aiming for at least 10% down for used cars and maybe 20% for new cars. But honestly, even putting down a little more than you initially planned can have a disproportionately positive effect on the loan terms you're offered.
Now, what if someone's credit isn't great? Maybe they're just starting out, and they don't really have the time needed to build it up significantly before they need a car. Is there any option for them to still get decent terms?
Yes, that's a common situation. If your credit score needs some work, or if you simply don't have the luxury of several months or a year to improve it before your car purchase is necessary, applying with a credit-worthy cosigner can be a highly viable strategy.
How does a cosigner help?
Well, when you apply with a cosigner who has a strong financial profile, good income, low debt, excellent credit history, the lender will consider both applicants' creditworthiness. Your cosigner's stronger financial standing and established credit history could potentially help you secure much better loan terms than you could get on your own, including a lower interest rate and more favorable repayment conditions. However, and this is a huge sharing, however, it's absolutely vital that the cosigner fully understands their responsibilities.
They're on the hook too, right?
Completely. They are equally legally liable for the entire loan. Any missed payments by the primary borrower will negatively impact the cosigner's own credit score and financial standing just as much. It's a very serious commitment that should only be undertaken with full transparency, trust, and a clear understanding between both parties involved.
Good morning. Okay, are there any other strategic moves people can make, maybe related to the broader market or timing, that can help them secure a better deal overall?
Absolutely. You can definitely be strategic by timing your purchase if you have that flexibility. In strong economic environments, when consumer demand is high and the economy is generally considered hot, interest rates tend to be higher across the board, partly due to actions the Federal Reserve might be taking to cool things down. So if you have the financial flexibility to wait, holding off until economic conditions perhaps cool down a bit and interest rates potentially drop could genuinely save you a significant amount of money on your loan interest over several years. Also think about specific timing like end-of-year sales events or even just the end of a month or a sales quarter when dealerships might be more motivated to hit sales targets and offer better pricing.
And just choosing a less expensive car in the first place?
That sounds obvious, but it's incredibly effective. Making a conscious decision to buy a less expensive car that genuinely meets your core transportation needs, rather than overextending your budget for features, performance, or luxury you don't truly require, is perhaps the most straightforward and highly effective way to immediately reduce your total borrowing costs and your ongoing financial burden. Don't buy more car than you truly need or can comfortably afford.
Great point. And finally, especially for those listeners looking at used cars, what's your ultimate piece of advice for vetting the vehicle itself to avoid buying someone else's problems and facing future headaches?
This is absolutely critical, especially with used cars. You must vet the vehicle thoroughly. Never, ever take a used car just at face value, no matter how clean and shiny it looks on the dealer's lot. First step. Always obtain a comprehensive vehicle history report. Services like Carfax or AutoCheck are invaluable. These reports can reveal crucial information about the car's past, things like reported accidents, flood damage, odometer rollbacks, salvage or lemon titles, or other major issues that could seriously impact the car's safety, reliability, or its future resale value.
And beyond the report.
If you're truly serious about purchasing a particular used car after reviewing the history report, always get an independent pre-purchase inspection, PPI, from a trusted third-party mechanic, someone you choose, not affiliated with the seller. This objective assessment, done by a professional who isn't trying to sell you the car, can uncover hidden mechanical problems, existing damage that wasn't obvious, or potential costly repairs looming just around the corner that might make the car unreliable or a financial drain soon after you buy it. This small investment, maybe $100 to $200 for a thorough inspection, can potentially save you from a major financial headache and thousands, literally thousands, in unexpected repair bills down the line. It's truly a non-negotiable step for any smart used car buyer.
Absolutely sound advice. Okay, let's recap this vital section on strategies. You, the consumer, actually have significant control over the terms of your car loan. By proactively working on your credit, strategically shopping around for the best financing rates before you shop for the car, making a substantial down payment, choosing the shortest loan term you can comfortably afford, and thoroughly vetting your chosen vehicle, especially if it's used. You can dramatically reduce your overall costs and really empower yourself in the whole financing process. That brings us to takeaway number 4. All right, we've given you a lot of tools and strategies for getting a good deal. But it's equally important, maybe even more so, to be acutely aware of the inherent risks and the rapidly evolving landscape of auto finance today. The market has truly transformed significantly in recent years, hasn't it? Especially since the pandemic. And that's brought new and often unpredictable challenges for consumers that perhaps weren't as prevalent just a few years ago.
You're absolutely right. And what's often underestimated, I think, is the pervasive ripple effect of recent global events, specifically on auto finance. The COVID-19 pandemic, for instance, led to unprecedented supply chain complications all around the world. We all heard about the semiconductor chip shortage, right? Well, that dramatically reduced the availability of new vehicles entering the market for a long stretch.
Which drove prices way up.
Exactly. This scarcity, coupled with a lot of pent-up consumer demand from people who had delayed purchases during lockdowns, inevitably drove up prices for both new and used cars to historic highs. Just to illustrate with some numbers, the average amount financed for new vehicles increased from approximately $33,000 back in late 2019, just before the pandemic hit hard, to over $40,000 by the third quarter of 2023. That's a huge jump. This substantial increase in vehicle prices and the resulting higher loan amounts, in turn, inevitably led to significantly higher average monthly payments for consumers. And this happened despite many borrowers resorting to those longer loan terms we talked about as a way to attempt to manage those higher payments and make them feel more affordable on a monthly basis. It really created a perfect storm for higher overall vehicle costs.
That raises a really important question about those longer terms, the 72, 84-month, even longer loans that we're seeing more and more. What's the hidden danger with these extended repayment periods? Why should people be cautious?
It's a significant concern among financial analysts and consumer advocates. We're observing a noticeable and frankly concerning rise in auto loans with these extended repayment periods of 84 months or sometimes even longer. Now, while these longer terms certainly achieve the immediate goal of lowering the monthly payment amount, which can feel like a necessary lifeline for budgets already strained by inflation, there's compelling evidence emerging that borrowers who take out these extended term loans tend to become delinquent on their payments at notably higher rates.
More likely to miss payments, even with good credit.
Yes, interestingly, this increased delinquency risk seems to hold true regardless of the borrower's initial credit score. It's the length of the loan itself that seems to be a factor. And critically, as we've hammered home, these longer terms dramatically increase the total cost of borrowing over time simply because you're paying interest for a much, much more prolonged period. You might think you're saving money each month because the payment is lower, but you're actually paying far more in total interest charges over the 7 or 8 years. You could effectively be financing the vehicle for longer than you even realistically plan to own it.
And you mentioned the risk of being underwater earlier. Does that specific risk increase significantly with these longer loan terms?
Oh, absolutely it does. The biggest financial risk associated with these extended terms is that they significantly increase the likelihood and duration of spending a prolonged period underwater. Remember, that means owing more on your auto loan than the car is actually worth in the current market. Because cars depreciate so rapidly, especially in the early years, and because interest payments are front-loaded on these amortized loans, you can very quickly find yourself in this negative equity position with a long-term loan.
And what happens if car values drop?
That's the scary part. If, for instance, vehicle supply chains fully normalize and maybe used car values start to decline more rapidly from their recent highs, this underwater situation could worsen considerably, leaving borrowers even deeper in negative equity. For borrowers who find themselves in this position and then need to sell or trade in their vehicle before fully paying off that long loan, they're much more likely to face that painful choice. Either pay the significant difference out of pocket just to get rid of the car, or perhaps more commonly, roll that leftover negative loan balance into their next car loan. And that just starts the whole process over again, but from an even worse starting point, further exacerbating their overall debt burden. It truly is a vicious cycle that's very difficult to escape once you're in it.
Okay, so long terms carry major risks. Beyond just the loan terms themselves, another risk I often hear about, one that's been around for a while but still seems to catch a lot of people, comes from optional add-on products sold during the financing process. Can you elaborate on these and why they're such a common pitfall?
Yes, this is a classic area in the finance office where consumers can easily get tripped up if they're not vigilant. These optional add-on products include a whole range of things: extended warranties, vehicle service contracts, GAP insurance, guaranteed asset protection, tire and wheel protection plans, VIN etching, fabric protection, even cosmetic upgrades. All vigorously marketed, usually by the dealership's finance manager or sometimes directly by lenders during that final stage of the buying process.
But the problem is people don't realize they're buying them.
Often, yes. The challenge is that many consumers aren't fully aware they're being charged for these extras, or they don't truly understand the real cost versus the actual potential benefit or value. Frequently, the cost of these add-ons is simply rolled into the total loan amount without a very clear explanation, subtly inflating your total loan by hundreds or sometimes even thousands of dollars. In many cases, these add-ons might offer little real benefit to you, or they might cost significantly more when purchased through the dealer than if you were to purchase a similar product separately from an unaffiliated third party.
Like GAP insurance.
Exactly. GAP insurance, for example, can be valuable if you have a small down payment or a long loan term, as it covers the difference between your loan balance and the car's value if it's totaled. However, it's often priced much, much higher at a dealership compared to what you might pay if you simply added it to your existing auto insurance policy through your own insurer. It is absolutely crucial to scrutinize every single line item on your purchase agreement and your financing contract. Question every single charge that isn't the agreed upon price of the car itself, plus mandatory taxes and fees. Don't be afraid to say no to add-ons you don't understand or don't feel you need.
Good advice. Now, thinking about the financing process itself, particularly when you're working through a dealership rather than directly with your own bank, what's the deal with dealer markups on interest rates? How does that work, and what should a listener be aware of there?
That's a very important and often misunderstood nuance, particularly with what's called indirect auto lending, where the dealer acts as an intermediary and facilitates the loan rather than you going directly to the lender yourself. The interest rate you're ultimately quoted by the dealer's finance manager often comprises two distinct components. First, there's the buy rate. This is the baseline interest rate that the actual lender, the bank or finance company behind the scenes, offers based on their assessment of your credit risk profile. And second, potentially, there's an additional amount called the dealer markup or dealer reserve.
So the dealer adds points to the rate.
Essentially, yes. This markup is an optional amount of interest, usually expressed as percentage points, that the dealer can add on top of the lender's buy rate, typically within a certain range or cap set by the lender. It's intended partly to compensate the dealer for handling the paperwork and facilitating the loan, and partly to incentivize them to present that particular lender's financing offer to you over others. Now, while some financial institutions do limit the maximum size of this markup, the dealer's discretion over whether to add it and how much to add can lead to variations in the final interest rate you're offered that are not directly correlated with your actual credit risk.
And that raises fairness concerns.
It certainly does. This practice also introduces potential fair lending risks if these discretionary markups are applied unfairly or inconsistently based on prohibited characteristics like race, gender, or ethnicity, rather than just creditworthiness. This potential for hidden markups is precisely why getting pre-approved by your own bank or credit union before you go to the dealership is so powerful. It gives you a concrete benchmark rate based purely on your credit to compare against the dealer's offer and helps ensure you're not paying an unnecessary markup on top of the rate you actually qualify for.
Okay, that's a really important point about dealer financing. Finally, looking ahead, we're seeing some new challenges emerging specifically with younger consumers, like millennials and Gen Z. How are their unique profiles and expectations impacting the auto finance landscape?
It's a significant demographic shift that lenders are grappling with. These younger generations are notably different from older cohorts in terms of their credit profiles and their expectations. For instance, studies show they are roughly twice as likely to have thin-file credit histories.
Meaning not much credit history to look at.
Exactly. They might not have a long track record of using credit accounts, maybe they haven't taken out significant loans before, or perhaps they primarily use debit cards. This leaves lenders with less historical data to accurately predict their future repayment behavior. This lack of extensive credit history often results in them being offered higher interest rates or sometimes having difficulty getting approved for loans at all, even if they have stable incomes and good financial habits otherwise.
And their expectations are different too.
Very much so. Moreover, these younger consumers have grown up immersed in a digital world with instant online transactions for everything else. They understandably expect a similarly swift, seamless, and largely digital loan approval process when buying a car. Many traditional lenders, however, still rely on older systems and more manual underwriting processes, and they often struggle to provide this kind of rapid, frictionless decision making that younger buyers expect. This disconnect creates a clear and urgent need for lenders to adopt more advanced technology, alternative data sources, and sophisticated data analytics that can quickly and accurately assess risk for these thin file, digitally native demographics. Otherwise, they risk losing a significant and growing portion of the future auto buying market. The auto market is undoubtedly dynamic, it's going to continue to evolve. And while future economic shocks or supply chain disruptions are inherently uncertain, it seems likely that the overall cost of vehicle ownership will remain a significant financial strain for many household budgets into the foreseeable future. Given all these complexities we discussed, being thoroughly knowledgeable about all your financing options, deeply understanding the subtle yet impactful mechanics of loans, and being keenly aware of these potential risks and pitfalls, it's truly more crucial now than ever for protecting your financial health and making genuinely informed decisions when you finance a vehicle.
Absolutely. So to bring this final section to a close, the current auto finance market presents some unique challenges. Things like those recently elevated prices, a concerning increase in the use of longer loan terms, and specific risks like ending up underwater on your loan, getting caught by hidden costs from optional add-ons, and facing potential dealer markups on your interest rate. Being aware of all these elements is absolutely crucial for protecting your financial health and ensuring you make the most informed decision possible when you finance your next car. That brings us to our final takeaway, takeaway number 5, #outro. Wow, we've covered a lot of ground today. We went from the basic mechanics of car loans to the intricate factors that influence your interest rate. We looked at those distinct choices between buying and leasing, gave you some really actionable strategies for securing a better deal, and highlighted the significant risks present in today's evolving auto finance market. It's definitely a complex world, but hopefully one you, our listener, now feel much better equipped to navigate successfully.
Absolutely. Let's quickly recap those 5 key takeaways for you one more time. Expert speaker. Takeaway number 1. The fundamental mechanics of auto loans, the loan amount, the APR, and the term length profoundly impact your total cost. Remember, a longer loan term might offer that lower monthly payment, but it almost always leads to paying significantly more in total interest over the life of the loan. Always look at the full picture, not just the monthly payment. Expert speaker. Takeaway number 2. Your auto loan interest rate is a complex calculation. It's based on your creditworthiness, current economic conditions, the specific lender's policies, the loan terms you choose, and even the type and condition of the vehicle you're buying. The good news, many of these factors are within your control, highlighting the importance of preparation. Expert speaker. Takeaway number 3. The choice between buying and leasing involves that fundamental trade-off. Lower monthly costs and always driving a new car with leasing versus building equity and having full control and flexibility with buying. Each option has distinct financial and lifestyle implications you need to weigh very carefully based on your personal situation. Expert speaker. Takeaway number 4. You have significant control over the terms of your car loan. By proactively improving your credit, strategically shopping around for the best rates before you shop for the car, making a substantial down payment, choosing the shortest loan term you can comfortably afford, and thoroughly vetting your chosen vehicle, you can dramatically reduce your overall costs. Expert speaker. Takeaway number 5. The current auto finance market presents unique challenges. Those high prices, the trend towards longer loan terms, and specific risks like being underwater, hidden costs from add-ons, and potential dealer markups. Being aware of these elements is absolutely crucial for protecting your financial health.
Ultimately, your car. It's more than just metal, rubber, and glass, isn't it? It's a tool. It's an enabler that allows so much in your life, from getting to work and school to accessing healthcare appointments, connecting with family and friends, pursuing hobbies, just experiencing life. Treating the financing of that tool with the care, the knowledge, and the strategic thinking we've discussed today can ensure it truly serves you and your goals, rather than becoming a source of financial strain or a persistent drain on your future well-being. So take a moment to consider what reliable transportation really means for your specific life, and then figure out how to make that happen responsibly within your means, not just for today, but for the long haul ahead. That's all for now, folks. Please like, share, and subscribe for more like this.